So earning passive income right now from your investments and savings portfolio is still very doable, of course, in 2024, but you do need to know where to look, which is what today's video is all about. Hey, what's going on everyone? It's Griffin here, and in today's video, we'll be looking over a variety of different options for you to choose from in the current market that'll provide your cash holdings and investments with either passive interest income or dividend income, depending on the position in question, where there are quite a few options that can fit different risk tolerances and investment strategies. So let's get started. All right, so arguably the simplest way to earn some passive income on your cash holdings is one that most people are aware of, being through earning interest on the cash that's sitting in your bank account, hopefully a high interest savings account, rather than your checking account earning 0.01% interest. Now, I've made several videos over the years highlighting some of Canada's best savings accounts and rates at those given times, which is one of the downfalls of high interest savings accounts, as their interest rate is generally dependent on the prevailing rate set by the Bank of Canada. That's in constant movement. As we speak though, in June of 2024, interest rates are still quite high due to the economic climate here in Canada, even though they have just been cut by 0.25%. But nonetheless, this means that interest rates on savings accounts and other fixed income investments are still relatively attractive, presenting an opportunity for those looking to earn a stable and reliable return on their cash holdings. Now, there are several options to choose from right now in Canada. In fact, here are some of the top options available with their current promotional interest rates that I'd recommend you look into further if you're interested. But let's cover some of the pros and cons of high interest savings accounts, starting with the benefits. So opening and setting up a high interest savings account is one of the simplest and easiest to understand ways to earn a return on your cash, and it offers relatively high liquidity on your cash as well. So if you're in need, you can easily access those funds. And finally, well, automatic interest deposits are made into your account, usually on a monthly basis, depending on the daily amount that is in your account. And then that is relative to the yearly interest rate. Of course, though, well, for the pros, interest rates do fluctuate over time, and good rates are usually only for a short duration of time. In Canada, most promotional rates are for 3 to 6 months, and then they'll drop down to a lower rate afterwards, which usually isn't all too competitive. Second con here, well, the best rate is generally not with your current bank and is only for new customers at a different bank. So switching high interest savings accounts for only a temporary interest rate can definitely be a hassle that may not be worthwhile. And finally, interest income isn't taxed favorably like dividend income and will be added to your regular taxable income as well. So that's also something to consider. Let's now take a look into the second option to earn interest income on your cash holdings while being able to do so through an investment account with favorable tax treatment. High interest savings ETFs are yet another compelling investment option for those looking to earn a stable return on their cash holdings while maintaining a higher level of liquidity than other types of equity investments. So these ETFs invest in a variety of high interest savings accounts and short-term fixed income securities, offering yields that are typically higher than traditional savings accounts over a longer period of time, rather than only for a short promotional period, with the added benefit of being easily tradable on a stock exchange, providing investors with a higher level of flexibility. What's more is that interest payments from these ETFs are typically distributed on a monthly schedule as well, just like high interest savings accounts, making them an attractive choice for individuals who may be seeking that regular income and without having to lock in their funds into a longer term commitment like a GIC, for example. And you can hold these positions in a variety of investment accounts, including say the TFSA or the FHSA, making it that dividend income that you're going to be receiving from said ETFs completely tax-free, which is quite advantageous compared to the interest received on your high interest savings account that, like we looked over earlier, is added to your taxable income. So here are a couple of high interest savings account ETF options to look into further that currently offers some competitive yields in the market. And let's now cover the pros and cons that these ETFs offer investors. Starting with with the pros, HISA ETFs generally offer higher but also more stable interest rates compared to those traditional savings accounts, providing an averaged out interest rate across the market that isn't subject to short promotional periods. Second pro is that these ETFs are easily tradable on stock exchanges, allowing investors to buy and sell shares quickly, which provides greater flexibility compared to those fixed term deposits like GICs. And finally, interest is typically paid out on a monthly schedule, providing a steady stream of income, which can be useful for covering monthly expenses or just simply reinvesting back into your portfolio if that's what you're after. Diving now into the cons, well, although they are relatively low risk, HISA ETFs can still, of course, be subject to market fluctuations and interest rate changes across the board, which may impact that rate that you're receiving on your invested funds. Second thing to look out for is that management fees and other expenses associated with ETFs can eat into your returns, making them slightly less attractive than directly holding in a high interest savings account. However, the fees for most of these HISA ETFs are on the smaller side. And finally, well, while they can offer higher interest rates than traditional savings accounts over a long-term averaged out, well, the returns from HISA ETFs are generally lower compared to growth-oriented investment options like equity ETFs, but that's the idea behind the HISA ETF anyways. All right, so we've now looked over high interest savings accounts and HISA ETFs, but what about an ETF option that focuses on investing in short-term debt instruments and cash equivalents to create a return on your investment? Well, in comes the money market fund or money market ETF, which is another type of investment fund that pools capital to invest in short-term, low-risk financial instruments such as treasury bills, commercial papers, and certificates of deposits. So these ETFs aim to provide investors with a safer place to invest easily accessible cash while generally offering a return that's going to be slightly higher than a traditional savings account as well. And just like with the HISA ETFs or any other ETF for that matter, money market ETFs trade on stock exchanges like individual stocks, allowing investors to buy and sell shares throughout the trading day at market prices, which is why they're popular among investors seeking liquidity, stability, and some income. In fact, here's an example of a Canadian money market fund offered by iShares, where you can see that the fund's share price hovers around $50, with fluctuations in share price relative to the dividend distribution each month when the dividend is issued. And the reason why the fluctuations are greater now and back in 2008, 2009 is because interest rates are higher, meaning a higher return for the capital invested in the fund. Oh, and by the way, if you're interested in finding some of these money market ETFs in your stock brokerage, well, here's how you can easily do so using the moomoo application. So just like finding any other ETF that you might be interested in, going into the market tab, searching for said money market ETF will bring you directly to the stock quote for that ETF. Otherwise, you can also find similar ETFs by looking in the markets tab as well and going into the section that's going to pull together various different exchange traded funds based on their investing style and certain characteristics. So that's an easy way that you can find some similar money market funds in the moomoo app. Let's now talk about some of the pros and the cons of using a money market ETF. Starting with the pros, money market funds invest in high quality short-term instruments, which makes them relatively safe and stable compared to other investment options, especially dividend-focused equity ETFs, and they're designed to preserve capital while providing that slight return. Second, these funds offer high liquidity, allowing investors to quickly access their money when needed, making them ideal for managing cash and maintaining an emergency fund if that's what you're after. And finally, due to their focus on those short-term, lower-risk securities, money market funds typically experience lower price volatility, which helps in maintaining a stable net asset value, as we looked over on the stocks chart. That being said, there are of course a few downsides, notably that the safety and stability of the money market fund comes at the cost of those lower returns compared to many other investment options, meaning that over time the returns may not keep pace with inflation. However, right now money market funds are a great way to earn some passive income, and the goal of these funds is never to grow the capital invested in the first place anyways. Second here, although generally low, money market funds do charge management fees. So it is important to take a look at the MERs charged by the ETF provider. In the case of CMR that we spoke about earlier, we're looking at 0.13%, which is very low. And finally, money market funds are sensitive to changes in interest rates. So when interest rates are low, the yield on these funds can be very modest. But like with all of the investing options that we're looking at today, these are options that are currently offering nice passive income due to the current market conditions right now. Hey, and by the way, all of the investment options spoken about in today's video can be found on most stock brokerages like Moomoo, for example, which makes investing in exchange traded funds incredibly simple to accomplish. In fact, Moomoo provides investors with that ability to not only gain thorough data relating to the individual stocks or ETFs that you're researching, but also access advanced trading tools and comprehensive market analysis data built right into the platform at no extra charge to you, as it's the only Canadian broker that offers free for users real-time level 2 market data for US and Canadian stocks. And unlike other online brokerages who charge up to $90 a month for these same professional features, Moomoo has no subscription fees, no minimum deposit requirements, and no account management fees. Now, if you're looking to discover ETF options that provide dividend distributions or with other specific criteria, you can easily do so in the market tab of Moomoo's app, and then clicking on thematic ETFs, where they're categorized ETFs based on criteria such as, say, monthly distributions and more. And once you've found an ETF that you may be interested in investing in, well, you can easily access the latest news and data relating to it, including fund information, position details, management fees, and much more, allowing you to make a more informed investment decision. What's more is that Moomoo has now introduced RRSPs and TFSAs to their lineup of available accounts with no minimum account fees or balances to get started. And new users who use my link down below in this video's description to register for a Moomoo account will unlock some hefty welcome rewards, where if you deposit $100, you'll instantly be able to claim $50 in cash rewards and an additional $1,888 commission-free card. And if you deposit $5,000, you can get $100 back right away. But that's really only if you're depositing funds. If you choose to actually transfer your account and you transfer $100,000 or more from another stock brokerage, you can receive an Apple gift card worth $1,200, which is enough to buy a brand new iPhone. So make sure to check out that link down below in this video's description. And speaking about dividend ETFs, this leads us into the final portion of today's video. Finally, we can't forget dividend-focused equity ETFs that, despite nice passive returns currently offered by many interest-focused positions like what we just covered, can still remain viable options for both capital growth and dividend income. Now, most dividend-focused equity ETFs invest in companies that have a history of paying consistent and often growing dividends, and these ETFs typically target more established and financially stable companies across various sectors, including usually the utility sector, consumer staples, and healthcare, which are known for their reliable dividend payouts. We've covered quite a few dividend ETFs on the channel in the past, but some options to look into right now include some of the following that are on screen. Some of the key benefits of dividend-focused equity ETFs include the following. So income generation is one of the main, of course, where these ETFs provide a steady stream of income through those dividend payments, which can be particularly appealing for reinvesting back into your account, thus growing it at an exponential pace, or investors seeking regular cash flow to maybe supplement other areas of their finances. Additionally, while generating income, dividend-focused equity ETFs also have the potential for that capital growth, as they invest in companies that may appreciate in value over time. And this is in contrast to basically the three other options that we looked at previously in this video, where you're not really looking at any underlying capital appreciation. Your investment return is strictly from the interest earned on the investment. And finally, investing in a dividend-focused ETF generally provides exposure to a diverse range of dividend-paying companies across those various sectors, reducing the overall risk associated with investing in a single individual dividend stock. That being said, here are a couple of considerations, of course. So despite their focus on dividends, equity-focused ETFs are still subject to market volatility, of course, and the value of the underlying stocks can fluctuate greatly, impacting the ETF's overall performance. So conducting proper research of the underlying companies within the ETF that you might be researching is, of course, paramount before making that decision. The second thing to consider here is that some dividend-focused ETFs may be more heavily weighted towards certain sectors, such as utilities or consumer staples, which could lead to less diversification and increased sector-specific risk. However, there are hundreds of dividend-focused ETFs both in the Canadian and American market to choose from. So here are a couple of options that you can start looking at if you're interested in doing so. All right, so thanks all for watching today's video. Really hope you enjoyed it. If you did, make sure to drop a like. It really helps the channel out. And don't forget to sign up using my link down below in this video's description for moomoo, where you can get some great sign-up bonuses for doing so. And if you want to learn more about investing in the stock market on your own, make sure to check out my stock market investing Skillshare course. It is completely free to access using the link down below. There's over 2,000 students, which is absolutely crazy, and has over 7.5 hours of video content. So with that said, thanks all for watching, and I'll see you in the next one.